Welcome to Alu Speaks with Alu Patience. Today we'll be discussing on the topic financial analysis in the course Corporate Finance. This is our second topic on Modules 2. If you have not watched our previous topics, I would advise you to do so. However, I have realized that most of us here do not have a business-oriented background. So I will be breaking to this class to be as simple as ABC. At the end of today's class, we should be able to know the meaning of financial ratios and the various standards of comparing financial ratios. We should also be able to classify financial ratios and know the importance and setbacks of financial ratios. And finally, we should be able to identify some financial ratios tools. Financial ratios, they begin with financial statement, meaning if you have not familiarized yourself with the structure of a financial statement, you may have a bit of difficulty here because most of these ratios, they get their data from the balance sheet and the income statement. So what is a financial ratio? A financial ratio is a mathematical tool that we use to compare items in the financial statement. That is, it shows the relationship between two or more figures in the financial statement. These financial ratios, they are usually shown with percentages. However, they can sometimes be shown as fractions and proportions. So what is financial ratio analysis? Financial ratio analysis is the practice of comparing financial ratios that we derived from the financial statement. If you are just joining for the first time, please subscribe, like and drop a comment or two if you need clarity. And don't forget to hit on the notification bell for future amazing topics. Now that we know what ratios are, what do we use these ratios for? We use them for what? Comparison. But against what? What are we actually comparing them against? We can compare these ratios we get from the financial statement against past ratios, against previous financial statements of the company. That is, we can compare these financial ratios we got with financial ratios that we have gotten in the past. This is more like a time series analysis, analyzing it with other ratios of the past. Or we can even compare it with just the previous year ratio. That is more like an horizontal analysis. What I'm simply saying here is that financial ratios we derive can easily be compared with past ratios so that we can derive a decision. Also, ratios derived from the financial statement can be compared against projected ratios. That is forecasted ratios. Ratios we believe to be ideal, we expect to be ideal. So we can compare them against such predicted forecasted ratios. Another name for this is called the pro forma analysis. We can also compare the ratio we get from against other successful firms in the same industry that are at a similar level with our own firm. This is more like a cross-sectional analysis, comparing our company with similar companies in that industries that are successful. We can also compare the ratios we get from our financial statement against the general industrial average, the prevailing industrial average in that industry we belong to. Instead of comparing it to a selected successful companies in that that look similar to us, we can compare it to the entire bodies of industries that look similar to us. We look for the average and compare our ratios with that. I hope you understand what industry means. Industry means a collection of companies in the same line of business. Like you can have a beverage industry or a fashion industry and whatnot. Some people ask, must we evaluate the ratios gotten against past ratios? Must we evaluate them against projected ratios? Must we evaluate them against competitors or even the industry? Can a company not evaluate the ratio against itself in its current year? Yes, you can. It is called vertical analysis. In this situation, you express each line, each item against a base in the financial statement. For instance, you can, like in an income statement, you can use sales as your base and say, oh, profit is 10% of sales, or expenses is 70% of sales. That what are you doing there? That is, you are evaluating your company's ratio against itself, against a particular base. What are the importance of financial ratios? Why are we doing it at all? We already know this. It is for what? Comparison. That is the main thing. It is for what? To use for what? Comparison. And it helps us to gain information about the company's efficiency, about the company's profitability, its solvency, how liquid the company is. It helps us to understand the growth of the company. It helps us to simplify complex accounting information into easy comparable ratios. It helps management to plan and forecast in their decision-making process. And it also helps us to locate weak areas in our company so that we can improve on those areas. Now I have listed some of the importance of financial ratio analysis. What are the limitations? These ratios are mathematics, that is, they are quantitative, which means they do not really put qualitative point of view into consideration. And also, if you use incorrect accounting data to calculate your ratios, you will get a false result. Inflation in the economy can easily distort the ratio figures, can easily distort the result you have calculated. This means that it does not consider social and economic condition of the company that may affect that company, that other companies, other similar companies may not be facing in their own environment. Ratios are just a guide. They are not actually a standard for measurement. As management, employees, customers, and people in general, they cannot actually be reduced to formulas. Now, let's go into the classifications of ratios. There are three major classifications of ratios. Ratios can be classified according to importance, according to users, and according to functions. When classifying ratios according to importance, we classify them into primary and secondary ratios, where the primary ratios are considered to be the most important ratios that should be more focused on. Example are, people believe that the investment ratios are more important. So the investment ratios are the primary ratios, while any other ratios that does not focus on investment should be considered a secondary ratio. However, this cannot be really correct, because what one company may consider as an important ratio, another company may not consider it as an important ratio, because not all companies actually focus on investment. We have companies like NGOs, they don't focus on investment. So using a primary and secondary ratio as a method of classification may not be the ideal. Also, people have said ratios should be classified according to users, because different users, that's according to the interest of the users, because different users have different needs. Because managers, for instance, they are more interested in ratios that help them in the operation and control of the company, while owners are more interested in ratios that tell them about their profitability, the profitability of the company, about the dividends they are about to receive, and about if the business, if that company needs more capital or not. What about the lenders? The lenders are more interested in the liquidity position of the company. They want to know, can this company pay their interest on loans as at when due? What about the creditors? They need to, and suppliers, they need to know if the company can pay back their credit as at when due. These various users have various interests. Finally, we have the classification according to functions. This is the most popular and most acceptable form of classification. It is even called the fundamental classification of ratios. It breaks down ratios into different groups. We have the liquidity ratio, the leverage ratio, the activity ratio, the profitability ratios, and the investment ratios. Liquidity ratios. Liquidity ratios, these are ratios used to measure the ability of the company to cover its short-term obligation as at when due. It is telling us, it is showing us if the company can pay off its liabilities, its short-term liabilities as at when due. If a company is insolvent, if a company is unable to pay its debts as at when due, that can lead to bankruptcy and even the death of the company, and nobody wants that. Lenders and creditors, they need this information. They need to know about the liquidity ratio of the company so that they can have confidence to know whether or not to lend money to such company, because nobody wants to lend money or give credit to a company that cannot pay back that debt or that loan as at when due. The informations you need to assess liquidity ratios can be gotten from the balance sheet. That is, from the current liability sections and from the current asset section. Why do I say so? Because we need a current asset to service our current liabilities. Because it is from the current assets you can get money quickly to service current liabilities. Because current liabilities, these are liabilities that you have to settle within 1 year or less. So where do you get money to settle them? It is from what? The current assets. Assets you can easily convert within 1 year to cash. Therefore, it means that the liquidity ratios measures how quickly we can convert assets into cash so that we can pay off our current liabilities as when they fall due. We have 3 common type of liquidity ratios. We have the current ratio, we have the quick ratio, and we have the cash ratio. The current ratio, it shows us how quickly our total current assets can cover our total current liabilities. That is, how quickly can all the current assets we have cover all our current liabilities. The most ideal result is for our current assets to cover our current liability twice over. So the most ideal result will be 2:1. However, 1:1 is okay. But anything less than 1:1, it means that our current assets cannot cover our current liabilities. Anything greater than 2:1, it means we are keeping excess of current assets over current liability. Our current assets is on the high side. The quick ratio is also called the acid test ratio. The quick ratio does not compare the entire current assets to current liability like the current ratio. In the quick ratio, we are only comparing our very liquid assets to current liability. By very liquid assets, I mean those assets we can easily convert to cash. If you look at the sample of current assets balance sheet extract we have on the board, you will see you have cash followed by commercial paper. That is a cash equivalent, something you can change to cash very, very fast. Then we have short-term investments. That's something you can convert to cash within 30 or 90 days. Then we have the trade receivables that can also easily be converted to cash. We have the inventory, and we have the prepayments. Here you will notice that the cash equivalent, the short-term investment, the trade receivables, they are very liquid assets that because they can easily be converted to cash in a short period of time. So those are our very liquid assets. But our inventory is not a very liquid asset. There is risk involved. The stock in your shop, you may not be able to sell it at the right time. So there's a risk involved. So it's not quite liquid. And prepayment, obviously we can't convert prepayment to cash. So for our quick ratio, we will say cash here plus commercial papers plus short-term investment plus trade receivables. This will make up our what? Our liquid asset all over what? Current liabilities. Like we said, 2:1 is an ideal ratio. 1:1 is okay. But below that, it shows that we may not be able to what? To pay our short-term liabilities as at when due. The last one is the cash ratio. The cash ratio is saying, can you cover your current liabilities with cash and cash equivalent only? This ratio is saying, abeg, I don't have time for you to go and start converting your short-term investment to cash. I don't have time for you to go and start converting your trade receivable or inventory to cash. I don't have time. I want my money right now, which means cash and cash equivalent. Do you get it? So that ratio is saying, can you pay your current liabilities with cash and cash equivalent? This ratio is very conservative. It is a very stringent ratio, and it is normally used by creditors who want their payment impromptu or as soon as possible. Profitability ratios. Profitability ratios, it measures the company's ability to generate profit. When a company is making profit, it assures us that that company is well operated and it is efficient. And who is interested in the profit of a business? All stakeholders. All stakeholders are interested in the profitability of the business, because if the business is not profitable, their interest is at stake. In our income statement class, I told you that to get your profit is simply minusing what? Expenses from revenue. That is, revenue minus expenses gives you what? Profit. Meaning that for you to make more profit, you have to either control your expenses or maximize your revenue. There are multiple ratios that you can use to measure the profitability ratios. They include the gross profit margin ratio, the net profit margin ratio, the operating profit ratio, the return on investment, the return on assets, the return on capital employed, and the markup on cost. These are some of the ratios you can use evaluating profitability. However, we are going to just touch on a few of them. The gross profit margin. The gross profit margin is telling us the unit profit we made per sales after removing just direct cost. And to compute for gross profit margin, you say gross profit over sales times 100, because we are looking for the answers in percentage. And we know in profitability ratios, the higher the percentage, the better for the company. So let's create a scenario. Let's assume we sold books for 1,000 naira. However, the cost of purchasing those goods was 600 naira. That means we made a gross profit of what? 400 naira. Therefore, what is our gross profit margin? Our gross profit margin here is 400 naira gross profit over sales 1,000 naira times 100, and this will give you 40%. So our gross profit here is what? 40%. Now, the net profit margin. The net profit margin tells us our bottom line profit. It tells us our bottom line profit for each 1 naira of the revenue we have earned. The net profit, it gives an overall view after considering everything on the income statement. Unlike the gross profit, we only deducted the amount we use in buying the books we sold. But in the case of net profit, we are removing all expenses we incurred in the business. Apart from buying the books, after all, we went to the market. We paid for transportations. We paid salary to our staff. We paid for electricity bill. We paid for other miscellaneous expenses. We are seeing now, after we have minus all these miscellaneous expenses, the bottom line profit is the net profit. So to get the net profit margin, or what you need is to say what? Net profit over sales times 100. Then you get your net profit margin. We ran a total expenses of 200 naira, which means our net profit is what? Also what? 200 naira. Therefore, to calculate our net profit margin, we would say a net profit 200 naira over total sales 1000 times 100, and that will give you a net profit margin of what? 20%. These two ratios I've just given you, that's the net profit margin and the gross profit margin. These are ratios that shows our ability to generate profit from what? From revenue. Remember, your sales is your what? Your revenue. Now, let's discuss other profitability ratios. Now, let's discuss the return on equity ratio. Shareholders are more interested in this ratio. Return on equity shows the unit of net profit generated over the total equity. By total equity, I mean the capital contributed by the owners and their retained earnings. That is the part of the profit they reinvested into the business. And let us understand that the net profit can be gotten from the income statement, while the total equity, those figures will be gotten from what? The balance sheet. That is from the liability sides of the balance sheet. In our next topic, we will really practicalize all these things I'm talking about. I just want us to understand it for now. Another ratio is the return on capital employed ratio. This ratio compares operating profit with capital employed. Now, what is operating profit and what is capital employed? Operating profit is that profit that excludes interest and tax. That is earnings before interest and tax. It is that part of profit where interest and tax has not been what? Deducted. And what is capital employed? Capital employed are the capital we employed into the business. And what are the capital we employed into the business? Is what? The owner's equity and long-term debts. Those are the capital we employed into that business. So when you say capital employed, you are looking at what? Owner's equity and long-term debt. So return on capital employed is what? Dividing operating profit all over capital employed. You realize that these two ratios I've just talked about, that's the return on equity and the return on capital employed. They look at the company's ability to generate profit from what? From capital employed and total equity. This means we can look at profitability ratios from the ability to generate profit from sales or from the ability to generate profit from equity and capital employed. The next one is the efficiency ratio. As the name implies, it monitors efficiency. It measures how well a company is using its resources to generate revenue. That is how the company is using its capital to generate what? Revenue. It is a measurement of the company's performance. It is also called activity ratio or turnover ratio because it monitors the number of times or days a company can convert its resources to cash. Some of these ratios include the debtors turnover ratio, the trade receivable days, the creditors turnover ratio, the trade payable days, the stock turnover ratio, the stock turnover days, and even the total assets turnover ratio. We are going to explain a few of these. If once I explain, then you can get the logic behind the rest. The debtor turnover ratio. The debtor turnover ratio can also be called the account receivable turnover ratios. It can also be called the sales to debtors ratio. So don't get confused when you see the name swapping. It means the same thing. This ratio simply measures how long it takes for customers to pay their debts. That means it measures how long it takes for our debtors to pay us the debt they are owing us. And we all know that the quicker a debtor pays you, the better for you, so that you can have your cash to do what you want. The debtors turnover ratio is calculated by net credit sales all over average account receivables. And if you are not giving net credit sales in your question, what do? It's simple. You take your total sales and you minus your cash sales. You get your what? Your credit sales, and that's your net credit sales. We call it net because we must probably maybe remove a sales return, if at all, if any. And your average account receivables is just your opening account receivables plus your closing account receivables divided by 2. That you just get the average between your account receivable at the beginning of the year and your account receivables at the end of the year. Then divide by 2, that you get an average. And the answer will be what? The numbers of time you are able to convert your debtors to cash. And we all know that the higher that numbers of times we can do that in a year, the better for us. Now, the trade receivable days. This time around, we are not looking at the numbers of times. We are looking at the numbers of days it will take for us to convert our trade receivables into what? Into cash. So here we simply say what? Our trade receivables divided by our credit sales for the year, our annual credit sales times what? 365 days, because we are looking for the numbers of what? Of days. What I just explained, that I explained for debtors, is also applicable for the creditors. I hope you get it. And we know here that the lower the numbers of days, the better for us, because we want our money as soon as what? Possible. Total asset ratio simply measures the number of times we can use our assets to generate sales. Therefore, total asset ratios is simply net sales divided by average total assets. And we already know that to get net sales is just you removing probably your sales returns from total sales, if there's any sales returns, and that is your what? Your net sales. And what is average total assets? With the word average, it simply means that what? We are adding opening total asset at the beginning of the year plus total closing asset at the end of the year and dividing by 2 to get what? The average. Now, stock turnover ratio. We can also call it inventory turnover ratio. It measures the number of times a company can restock or turn over its inventory in relation to its cost of goods sold. Therefore, stock turnover is simply cost of goods sold over what? Average inventory or average stock. And we know what average is again: opening stock plus closing stock divided by what? 2. And cost of goods sold is likely to be given to you in your income statement. And we want our stock turnover ratio to be high. don't we? Because we want to be able to sell and restock as soon as possible, as fast as possible. Sometimes we can even have the inventory turnover days. Instead of measuring the times, we measure the days. And that will just be average inventory over cost of sales times what? 365 days, because we have 365 days in a year. I think we'll have to talk about the remaining types of ratios in our next class, because this class is getting extremely long.